History, as the old saying goes, does not repeat itself, but it often rhymes. We see patterns, echoes of the past, returning in new and sometimes unsettling forms. Today, as we look out at the global economic landscape, many of those familiar rhymes are growing louder. The rhythm of rising interest rates, the persistent hum of inflation in the costs of daily life, the shifting tectonics of global trade. These are not just abstract headlines, they are tremors. They will eventually be felt in our communities, in our jobs, in our savings. This convergence of patterns raises a simple, yet profoundly important question for millions of people. Will the small investor be ready for the next economic shock? The question is not one of fear-mongering. It is a question of simple prudence. Over the last decade, we have experienced relatively low interest rates and strong market performance. That has lulled many into a sense of security. But the economic weather is changing. The winds are picking up. The sky looks different than it did just a few years ago. Ignoring these signs is not an option. For those building their financial futures one paycheck at a time, the real test of an investor is not how they perform when the sun is shining. Small investors face a unique and often challenging set of circumstances. Unlike large institutions or high net worth individuals, the everyday person is typically investing with a limited pool of capital. Every dollar saved represents a significant sacrifice, an hour worked a small luxury foregone. This reality means that the margin for error is razor thin. A substantial loss in a portfolio is not just a number on a screen. It can represent a delayed retirement, a canceled home renovation, or a more difficult path to funding a child's education. This heightened sensitivity to losses makes small investors particularly vulnerable to the emotional turmoil that accompanies market downturns. Furthermore, access to information and resources is often asymmetrical. Large investment firms have teams of analysts, sophisticated algorithms, and direct lines to industry experts. The small investor, by contrast, is often navigating the complex world of finance with little more than news headlines, social media trends, and the occasional article from a financial publication. They may not have the time between working a full-time job and raising a family to conduct deep-dive research into macroeconomic trends or the fundamentals of a specific company. To prepare for what is coming, you do not need a crystal ball. You just need to know where to look. The economy gives us signals, much like a doctor checks a patient's vital signs. By monitoring a few key indicators, small investors can get a better sense of the underlying health of the financial system and make more informed decisions. The first and most immediate signal is inflation. While headline numbers may fluctuate, it is the stickiness of core costs that truly matters. Housing, energy, food insurance. When these essential expenses remain stubbornly high, they act as a slow, grinding tax on your savings, eroding the real value of your money and making it harder to achieve returns that grow your purchasing power. Second, keep a close eye on interest rates. Central banks, like the Federal Reserve, use interest rates as their primary tool to manage the economy. When they raise rates, they are hitting the brakes to cool down inflation. This makes borrowing more expensive for consumers and corporations, which can slow economic growth and put downward pressure on stock prices. Conversely, when they cut rates, they are hitting the gas to stimulate a weak economy. Rapid and significant moves in either direction create instability. For small investors, the key is not to predict the next move, but to understand the direction of policy. One of the most common mistakes small investors make is confusing collection with diversification. Owning 20 different technology stocks is not diversification, it is concentration. True diversification is about function, not just numbers. The core principle is to own a mix of assets that behave differently in various economic environments. Think of it like building a team for a sports competition. You do not want a team of only star quarterbacks, defensive players, offensive players, special teams. Your portfolio should be constructed with the same logic. When one part of your portfolio is struggling, another part should be holding steady or even thriving. That creates balance and reduces the severity of overall losses. Deliberately own assets with different roles. First, have your growth assets. Broad market stock funds, like those tracking the S&P 500 or a global index. Their function is long-term capital appreciation and capturing economic upside. Second, you need defensive assets. They provide stability and calm when markets are in turmoil. High-quality government and corporate bond funds are classic examples. In today's hyper-connected world, we are conditioned for instant gratification, you know. We want immediate results. The world of investing is no exception. Real-time market data, flashing red and green on our screens, creates urgency and a short-term focus. This is a trap. For the small investor, a powerful strategy is to extend your time horizon. Short-term market movements are largely unpredictable noise, a chaotic mix of algorithms, news reactions, herd behavior. Trying to navigate this daily static often leads to wealth destruction, not creation. A long-term perspective is the antidote. Think in terms of years and decades, not days and weeks. A 20% market drop is terrifying if you're focused on the next month. But if your goal is retirement in 25 years, that same drop looks very different. It becomes a temporary dip in a much longer upward journey, maybe even an opportunity. Commit to a long-term plan, and you give your investments their most important asset, time. Time lets compounding work its magic and gives markets a runway to recover from inevitable downturns. In the world of investing, cash is often misunderstood. During bull markets, it is frequently derided as trash because it earns little, and its value is eroded by inflation. But in times of uncertainty and downturns, cash transforms. It becomes dry powder, a strategic asset that provides safety, flexibility, and opportunity. Keeping a portion of your investment portfolio in cash or cash-like assets such as short-term treasury bills is not a sign of fear. It is a sign of preparation. Its primary function is to give you options when others have none. When markets fall and fear is rampant, prices of good quality assets can become disconnected from their true value. This is when the best buying opportunities emerge, and those with dry powder are the ones who can take advantage of them. This strategy is not about trying to time the market's bottom perfectly. It is about having the liquidity to act when assets go on sale. Imagine a scenario where the stock market drops by 25%. The investor who is 100% invested is forced to simply ride it out. But the investor who has kept 10% of their portfolio as dry powder has the ability to deploy that capital and buy quality assets at a significant discount. Human emotions are the small investor's greatest enemy. Fear and greed are the most powerful primal forces that have derailed more financial plans than any market crash. The most successful investors understand this, and they do not rely on sheer willpower to overcome these emotions. Instead, they build a system of rules, a predefined plan of action that removes emotion from the decision-making process. Trying to predict the market's next move is a losing game. A far better strategy is to use simple defensive rules that protect your portfolio from your own worst instincts during times of stress. These rules act as a guardrail, keeping you on the path of your long-term plan when panic is telling you to swerve off the road. One of the most effective and simple rules is periodic rebalancing. For example, you might decide to rebalance your portfolio back to its target allocation once a year. If your target is 60% stocks and 40% bonds, and a strong year for stocks has pushed your allocation to 70-30, your rule dictates that you sell some stocks and buy some bonds to get back to 60-40. It is easy for the small investor to feel at a disadvantage. They lack the capital, they lack the research teams, they lack the institutional access of the financial giants. However, this perspective overlooks several powerful hidden advantages. The first and most significant is nimbleness. Big funds manage billions. They can't sell large positions without moving the market. Their size makes them slow and cumbersome. A small investor can adjust their portfolio. deploy cash. Enter a position with a few clicks. This speed and low market impact is a real edge. Another advantage is the absence of external pressure. Fund managers answer to a board of directors, a committee, and demanding clients who expect strong quarterly performance. That pressure breeds herd behavior and short-termism that prevents a long-term view. The small investor answers only to themselves. The next economic shock will not send an invitation. It will arrive with the noise and confusion that accompanies all major market events. It will test your resolve. It will test your discipline. It will test the durability of your financial plan. In that moment, those who have spent their time trying to predict its exact arrival will find themselves just as lost as everyone else. But those who have spent their time preparing will be ready. The central lesson of financial history is this: preparation is infinitely more valuable than prediction. The goal is not to be right about what is coming. The goal is to be resilient no matter what comes. For the small investor, this mindset shift is everything. You do not lose because you are wrong. You lose because you are unprepared. You are not a large institution that can absorb massive shocks. You are building a future, brick by brick. Your foundation must be solid. That foundation is built with the simple, practical steps we have discussed. It is built with an emergency fund that acts as a firewall against life's emergencies. It is built with a strategic cash reserve, your dry powder, that allows you to turn crisis into opportunity.